In the span of just a few years, we've witnessed some of the most mind-boggling stock market performances. It's not uncommon to see companies going from near bankruptcy to becoming household names, with their stock prices skyrocketing to dizzying heights. One such example is Rivian, an electric vehicle manufacturer that went public in 2021 at a valuation of around $50 billion. Fast forward to today, and its market capitalization has more than quadrupled to over $200 billion. But what's even more astonishing is the way these companies have been able to command such sky-high valuations, often without generating significant revenue or profits. Take Tesla, for instance. While it's true that Elon Musk's vision for sustainable energy has resonated with investors, the company's financial performance doesn't quite justify its current market cap of over $1 trillion. In fact, in 2020, Tesla reported a net loss of over $721 million, yet its stock price continued to soar. The phenomenon is not limited to these two companies alone. Take DocuSign, a digital signature platform that went public in 2018 at a valuation of around $4 billion. Today, it's worth over $50 billion, despite only generating around $1.5 billion in revenue last year. The numbers are staggering, and more than a little confusing. So what's behind this investing madness? Is it a case of investor euphoria, fueled by speculation and hype? Or is there something more fundamental at play? We'll be exploring these questions and digging deeper into the world of high-flying stocks to uncover the truth behind their remarkable performances. In the past decade, we've witnessed a seismic shift in the investing landscape. The rise of electric vehicles has been one of the most remarkable stories, with companies like Tesla leading the charge. Founded in 2003 by Elon Musk, Tesla started as an ambitious startup but quickly gained traction with its innovative approach to sustainable transportation. In 2010, Tesla's market capitalization was a mere $12 million, making it one of the smallest public companies at the time. Fast forward to today, and Tesla's story is one for the ages. After going public in 2010, the company's stock price skyrocketed from $17 to over $2,000 per share in just 5 years. During this period, Tesla's market capitalization grew by a staggering 123,000%, making it one of the most valuable companies in the world. This unprecedented growth has left many investors stunned and wondering what's behind such incredible momentum. One key factor contributing to Tesla's success is its pioneering role in the electric vehicle, EV, market. As governments around the world implement stricter emissions regulations, consumers are increasingly turning to EVs as a cleaner alternative. Tesla's early mover advantage allowed it to corner the market on EV production and distribution. The company's innovative products, such as the Model S and X, have been widely praised for their performance, range, and design. Tesla's growth has also been fueled by its strong brand identity and leadership under Elon Musk. As a visionary entrepreneur, Musk has played a significant role in shaping public perception of electric vehicles and convincing consumers that they're not just eco-friendly but also desirable. Under his guidance, Tesla has expanded beyond EVs to solar energy and energy storage solutions, cementing its position as a leader in the clean energy space. As we delve deeper into the world of investing, it becomes clear that there's more to Tesla's success than meets the eye. The company's growth trajectory raises important questions about market dynamics, speculation, and the role of innovation in driving stock prices. As we explore the phenomenon of these astronomical price increases, it's essential to examine a pivotal development in the investing landscape. The emergence of Robinhood, a mobile trading app, has revolutionized the way people invest. Launched in 2013 by Vladimir Tenev and Baiju Bhatt, Robinhood democratized access to the stock market, making it possible for anyone with a smartphone to buy and sell stocks commission-free. In 2020, during the COVID-19 pandemic, Robinhood's user base surged exponentially. Between January and March of that year, the app added over 3 million new users, bringing its total user count to approximately 10 million. This influx of new investors, many of whom were trading for the first time, helped fuel the frenzy around certain stocks. A prime example is GameStop Corporation, GME, a brick-and-mortar retailer that had struggled to adapt to the shift towards e-commerce. Despite its financial woes, GME shares skyrocketed in January 2021, rising from $17 to over $380 in just a few weeks. This meteoric increase was largely driven by retail traders on platforms like Robinhood and Reddit's Wall Street Bets forum. The sheer scale of these price jumps is staggering. Take the case of Clover Health Investments, CLOV, a health insurance technology company that went public in December 2020 at $12 per share. By January 2021, its stock had soared to over $200. Such astronomical gains are not limited to individual companies, entire sectors have seen explosive growth. In recent years, the S&P 500 index has risen from around 2,400 to nearly 4,800, representing a staggering gain of over 100%. While this upward trend is certainly encouraging for investors, it also underscores the potential risks and pitfalls associated with investing in today's markets. As we continue our investigation into the investing madness, let's examine further evidence of these extraordinary price fluctuations and explore their underlying causes. As we've seen with companies like Rivian, their stock price skyrocketed from $12 in February 2021 to a staggering $179 in July of the same year. But what's driving this extraordinary growth? Is it something intrinsic to the company itself, or is there a larger market phenomenon at play? One possible explanation lies in the way investors are valuing these companies. With the growing emphasis on ESG investing, environmental, social, and governance criteria, investors are increasingly willing to pay premiums for companies that align with their values. This can lead to exaggerated price movements, as seen with Rivian, which has pledged to go carbon neutral by 2040. But there's another factor at play here: the rise of meme stocks and social media-driven investing. Platforms like Reddit and Twitter have become breeding grounds for speculative trading, where investors jump on bandwagons driven by hype rather than fundamentals. This can create a feedback loop, where prices rise due to speculation, which in turn fuels more speculation. Take GameStop, for instance. Its stock price skyrocketed from $17 to over $480 in January 2021, largely driven by retail investors using social media platforms to coordinate their trades. While some argue that this is a democratization of investing, where individual traders can level the playing field against institutional giants, others see it as a recipe for disaster. The real-world implications are far-reaching. As more and more investors get caught up in these speculative fervors, they risk losing large sums of money. Furthermore, this kind of market manipulation can have broader consequences, distorting the natural functioning of the economy. It's essential to understand what drives these price movements and whether they're sustainable or just a fleeting phenomenon. By examining the underlying causes, we may uncover some uncomfortable truths about the state of modern investing. As we dive deeper into the world of investing, a pivotal moment emerges. It's around 2020 that I started noticing a significant shift in investor behavior. What was once considered a rational and informed process began to take on a life of its own. The narrative around electric vehicles, EVs, started gaining traction, with companies like Rivian Automotive Incorporated, which had previously filed for bankruptcy, suddenly experiencing an unprecedented surge in value. Rivian's IPO in 2021 raised over $12 billion, catapulting the company into the limelight. However, this wasn't just a one-off event, it marked the beginning of a broader trend. As we fast forward to today, Rivian's market capitalization has ballooned to nearly $30 billion, representing an astonishing return on investment for early adopters. But what's driving this investing madness? One major factor is the shift in investor focus towards ESG, environmental, social, and governance, metrics. With growing concerns about climate change and social responsibility, investors are increasingly looking for companies that align with these values. Companies like Rivian,